Hello, Kinaway members. Thank you for joining us for yet another one of our webinars. Today, we will be talking tax with Damien Foley and talking tax for your business. So before we begin, I would like to acknowledge the traditional owners of the land on which I am coming to you all from and in which Damien is coming to you all from. And I would also like to acknowledge the traditional owners of the land in which each and every one of us are tuning in from and pay respects to elders past, present, and emerging. Quickly, before we get this show on the road, I would like to remind you all that we have a bunch of informative webinars on various topics, and they are available to you all on our Facebook and YouTube channel. So please feel free to jump on at any stage and make yourself familiar with that content. Also, please feel free to share our posts and profiles with your friends and family, as we are looking to grow our Kinaway community even more than we already have. So along with the webinars, Kinaway are still offering the usual forms of business support for our members. So if you feel the need, you can contact us for assistance and support of any kind. Remember, Brendan here is available at 1-800-KINAWAY. And yes, feel free to get in contact with us and the team here at Kinaway. So before I introduce today's guest to you all, I would just like to note that the information provided is factual in use only and is not intended to be financial, tax, or legal advice and should not be relied upon as such. The information is general in nature and may omit details that could be significant to your particular circumstances. Okay, so now that we have all of that out of the way, let's give a warm welcome to our guest this morning, Kinaway's Research and Business Development Manager, Damien Foley.
Hi, Katani, how are you?
I am good. How are you this morning?
I'm very well, thank you. Looking forward to this. We're obviously coming up to the 30th of June, which everyone knows is end of financial year.
Yes, people like myself are probably in need for a webinar on this exact topic because I am not super versed in this. So I'm very happy to have you here today. So Damien, could you tell me what are the different types of taxes businesses have to pay?
Yeah, the first and most common one everyone knows is income tax. This is when at 30 June, the end of the financial year, everyone starts to prepare their tax returns. These are known as income tax returns. The second most well-known is goods and services tax, or GST, introduced just before the Sydney Olympic Games in 2000 to replace the sales tax. This is where GST is collected and paid by businesses, and they then pay the difference to the ATO each quarter or month, depending upon registration, and some can lodge it annually. The third one, some businesses may not be aware of, is called Fringe Benefits Tax. This is a special tax that was introduced back in the late 90s to collect revenue from big companies that were taking their long Friday lunches on the corporate credit card and charging it back to the company as a tax deduction. The Fringe Benefits Tax was meant to reduce this, but Fringe Benefits Tax now actually impacts small businesses also, not just the bigger end of town. There are other taxes such as luxury car tax and the wine equalisation tax, but these are very specific to the specific industries that they relate to, such as the car industry and the wine growing industry.
Excellent. Thank you, Damien. So my next question is, can you tell me how income tax is calculated for a business?
Yeah, so the income tax starts by first calculating what revenue has been earned by the business. For most businesses, this is straightforward. It's the sales you make excluding GST. There are some businesses that may receive tax-exempt income, but this is not very common. Businesses can earn other forms of income not through sales that are also accessible, such as bank interest earned or on your bank account. Next, we'll look at the deductible expenses. What we need to make very clear is not every expense you make for your business is a deductible expense for tax purposes. For example, when many government fines, such as speeding fines or parking fines, are usually not tax deductible. When we were talking about fringe benefits tax, we were talking about long lunches. Well, certain meal and entertainment expenses are not deductible by businesses also. Some expenses you might be able to claim part, but not all of the expense. A good example of that is a private car that is used for business travel. Then there are different ways to calculate how much you can claim as a business tax deduction. So it's very important to understand what your business can and can't claim as a deductible expense, as it will make a difference in the amount of tax you pay. The next is to then work out what your taxable income is. This is your assessable income less your deductible expenses to give your taxable income. So income minus expenses, taxable income. From this taxable income, you will then apply a tax rate. What tax rate you apply will depend on what your tax structure is. For example, sole trader will pay their taxable income, in their personal income tax return at their individual marginal tax rate. So the amount you pay in tax will go up as a percentage the more your taxable income is. A partner in a partnership has the business taxable income prepared in the partnership tax return, but is then split between the partners. And then taxable income the partner receives is then paid at the marginal tax rate in their personal income tax return, similar to a sole trader. A business that is held in a discretionary or unit trust will be the same, where the taxable profit is usually distributed to the beneficiaries from the trust, and then the beneficiaries are taxed on the profit distribution at their marginal tax rates. Some years ago, it was suggested for tax planning purposes to leave some profit in the trust, so the trust prepares an assessable trust tax return, which is then taxed at the highest marginal tax rate. There are changes occurring to the company tax rates also that are currently occurring. The highest is 30%, but for certain companies, it is reducing over time. So for certain companies, the 2021 company tax rate will be as low as 26%. This is the company tax rate on profits held in the company and prepared in a company income tax return. If the company provides a dividend to shareholders or pays salaries to employees who are also owners, then the dividends and salaries will have to tax at the marginal tax rate to the owner in their personal income tax return.
Damn. I heard a bit about long lunches and I got worried. So my next question for you is GST is something that I have heard of, but what is it and when is it relevant to a business?
Yeah, as mentioned, GST is a goods and services tax. For many businesses, they will need to register for GST when they forecast their sales turnover is going to be more than $75,000 for the year, for the financial year. Note I said predict. So if you aren't registered for GST and at the end of the financial year your turnover is more than $75,000, then talk to your accountant, because you really need to do that prior to your turning over the $75,000, or when you estimate your turnover is going to be $75,000 or more for that year. $75,000 is the GST threshold for profit for-profit businesses. Other entities will have a higher GST threshold at $150,000, namely the not-for-profit organisations. GST for most small businesses is paid quarterly, but depending on how much your turnover is, you may be able to lodge annually or you may have to lodge monthly. GST is typically 10% on top of the goods or services subject to GST. Not all goods and services have GST on them, and therefore not all GST is 10% of the sale or purchase price. For example, certain sales of goods and services overseas do not have GST to be added to the sale price.
So is that why when I go to the airport, I can get stuff particularly cheap? I think that's it, right?
The import and excise duty, yes, that's another part. That's another different type of tax as well that come into play. So,
see, guys, that's about as much knowledge as I had about GST until the lovely Damien decided to inform us. My next question. So you mentioned fringe benefit tax, but I was wondering, what is fringe benefit tax?
Yeah, so first, the fringe benefits tax year is from the 1st of April to the 31st of March. So it's not the same as the Australian financial year, which is from the 1st of July to the 30th of June. So that's the first thing to mention. As mentioned also, the fringe benefits tax, or FBT, is a tax when your employees receive certain benefits from being your employee. So the key word is that your employees receive a benefit as your employee and not when you provide them a benefit. For example, if you had an employee that goes to the AFL Grand Final in a corporate box with a client or supplier, you could still have to pay FBT, even though you didn't provide that benefit yourself or your business didn't provide that benefit. So some of the common FBT that a business may provide for their employees are a motor vehicle or meal entertainment. And again, I note I use the word entertainment for meal. So you need to understand when you provide meals for your employees, whether they are deductible or not deductible for tax purposes, and when they may attract FBT or fringe benefits tax. Meal entertainment also includes alcohol. So Christmas parties are a good example of where this might apply to a business for fringe benefits tax purposes.
Alcohol, you say? Sorry, I need to be noting this down and not joking around. I do have a final question. So what is tax planning and why is it important for businesses to do this?
Yeah, tax planning is part of working out the best way to organise your business to reduce or defer the amount of tax you have to pay. I personally don't like to use the words tax minimisation or tax avoidance. I'd rather think of it as organising your business to pay the correct amount of tax using the tax system and its rules to do so. So it's all above board and make sure it's done correctly. You're not trying to rip off the government or the ATO in doing this. It's all legitimate as far as tax planning. So the first point you would want to start looking at your tax planning is when you lodge your March quarter business activity statement. This gives you about 9 months of your sales from this, and from this you can then predict what your expected taxable profit is for the 12 months for a full financial year. And so in predicting this, you can then start to plan what you can do to reduce or defer your taxes for the coming 3 months or over the coming 3 months. Another example is using tax structures as trusts and companies. As we discussed, the company tax rate is no more than 30% and as low as 26%, at least for the 2021 financial year, whereas the personal marginal tax rate is as high as 47%. So 47% to as low as 26%, big difference. So just as a rule of thumb or a guide, working out when you should look at moving from a sole trader to a company, for example, is when you are making, say, around the $70,000 or more in taxable income. This is because the ordinary person makes an average income of around $70,000 and will likely need this to live off, so for their own personal expenses and living needs. But the marginal tax rate is at 32.5%, which is above the company tax rate of 26% or 30%. Another is using the FBT and the otherwise tax deductible rules, which are a part of the FBT regulations. These are important to use as an employee of a company. So these include in-house fringe benefits, paying for certain personal expenses through your company that are legitimate for tax deductions.
Thank you, Damien. Now, a quick question. Does everybody have to pay the same amount of tax?
Look, it can depend on certain aspects. So probably a good example is, say, the creative industry. So those in performing arts or live performing or live artists, some of those people in business in those areas can take advantage of certain tax rules or regulations. So an example of that would be, say, the tax averaging regulations or rules for artists or performing artists. So what that does is it's been introduced for the purposes of artists. They might have what would be called lumpy income. So an artist who does paintings, they might sell a lot of artwork in 1 year, but then make no sales the next year. So their profit might be very high for 1 year and very low or have no profit at all for another year. So the ATO has taken understanding or recognised this and said, well, look, we're going to average your income from the sale as an artist or in the creative industry, and we're going to average that over 5 years. And so it just smooths out your income, so you're not getting very high income that's taxed could potentially be taxed at a very high rate, and actually reduce that and create what will be the average of what your income would have been would be over 5 years. So there are certain special rules for different different people in different industries or different businesses in different industries. So these are some of the questions you can always ask your accountant about or tax advisor around whether you are subject to some of the special benefits based upon your industry.
Yes, I literally have never heard of that until today, guys. So we're learning something new every day here at Kinaway. So everyone, this has been a very short, little, tasty, little bite-sized webinar today. Damien saved the day and decided that we would talk about what we're talking with tax in this webinar. So if you guys like this sort of topic, and especially if you'd like Damien to maybe do another longer form version of this, like his other one, which you guys can go and watch now. It's called How to Read a Profit and Loss Statements. Got that right? So I would encourage you all to go and watch that. And if you enjoyed this and found this helpful, let us know. We can organize a longer one. Also, comment your questions below so that Damien has an idea of what sort of things the Kinaway community are looking to learn. Like we said, this isn't financial, tax, or legal advice. It is just two friends having a yarn about tax. But yes, I hope that you guys all enjoyed this. I would just like to thank all of you for joining us today, and a special thanks to the wonderful Damien for joining us on this morning's discussion. We hope that you all enjoyed it. And again, if you would wish to catch up on previous workshops, panel discussions, or interviews, jump on the Kinaway Facebook and YouTube, and you can find them all there. I would also like to take a moment to remind you about 1-800-Kinaway. It is an essential service, and if you would like support from Brendan's team, I would suggest calling that number. You can always reach out to the Kinaway team and we will get you in contact with him as well. So thank you again, Damien. Thank you, everybody. And we'll see you next week with another Kinaway webinar.
Thank you, Charlie. Bye.
Bye, everybody.